Welcome to the Real Estate Power Play Podcast, your launch pad for skyrocketing success in real estate investing. I'm your host, Gabe Rodarte, alongside Mark Monroe. We're ready to bring you transformative stories, groundbreaking strategies, and the insider secrets of real estate giants. Get ready to accelerate your investment journey and become a true power player in the world of real estate.
All right, welcome to another episode of Real Estate Power Play. I am your host this week, Mark Monroe, and I'm excited. We've had Brent on a few times. Brent is actually my firm that handles my books, my CPA, if you will, and been doing business with them quite some time. We're for business, and they specialize in real estate and tax strategies. So, Brent, thank you so much for coming on. Why don't you go ahead and do it? And first of all, for these guys that are watching this, and if you watched the other ones in the past, I mean, Brent, look at you. I mean, I didn't even recognize you at first. I thought you kind of looked like Vanilla Ice there for a second, compared to,
I
but
appreciate that.
congratulations. How much
I,
weight did you lose?
I've lost 195 pounds. I've lost more weight, or basically about the same amount that I weigh now. So I started that journey a couple years ago, and you're right. The videos on my website, the videos that we've done in the past, people probably don't recognize me, but it's still Brent Carlson, owner of Corporate Capital. Quick story, Mark. I've had a couple clients come in recently that I haven't seen in a couple of years, 2, 3 years, and I go in, I start talking to them, and it's business as usual for me. But the last two people have literally asked, "Where's Brent?" And they did not recognize me. So it's funny that you say that. So, but no, it's been a heck of a journey, but I feel great. You look great too, sir.
I appreciate it. Thank you. Yeah, if your voice, that's what's recognized. When you first came on, I was like taken back for a minute. So congratulations, and you feel great now, and it's part of our journey in life.
Well, yeah. Well, thank you. I appreciate you taking time to recognize that. It's but for all of us, we all go through different challenges and ups and downs, and it's been a remarkable and I've never felt better. So thank you.
Oh, well, we're going to talk a little bit about, it's that time of year. It's been about a year since you've been on, but we're coming to the end of the tax season right now. We're at the end of here in December. I can't believe it's the holidays. I can't believe we're going to go into 2026. Isn't it crazy?
It goes so fast. So
So
Christmas
so
is
let's
going to
talk.
be here.
Let's talk a little bit like people that especially real estate investors is normally who people are listening to right now, but like people that that sold some real estate this year and they're going to be getting hit with some taxes and capital gains, and then we're going to talk a little bit about asset protection a little bit later on. But what's your best advice for real estate investors now? Before the end of the year, we got like 2 and 3 weeks left to kind of move everything around. Why don't you kind of talk a little bit about that, what you've seen where other investors made a mistake where they should have done stuff now instead of in January?
Yeah, and I really appreciate you bringing that up, Mark, because one thing that we really like to focus on with our clients is having those conversations, as you mentioned, in December before January, or I always tell clients before the clock strikes midnight on December 31st, because at that point in time, you might as well go to like an H&R Block or somewhere else because you're just plugging in numbers at that point. So it's very important to have a relationship, go over those numbers as far as, if you have rental properties out there, what are the different things that you can do, whether it's structuring. We've had clients that have set up different layers of corporations, added a C Corp that have saved them $40,000, $50,000 in taxes. As you know, Mark, in real estate, you have your depreciation, you can look at cost segregations. So we'd like to look at everything before the end of the year to make sure that that is implemented, because there is a significant way to reduce your tax liability through proper structuring and advanced tax planning. But again, you got to do it now. And if your CPA or accountant is used to calling you January, February to get you to enroll or pay for that year, again, you're just at the mercy of your numbers. So it's very important to plan. And there's a couple strategies that I would like to go over, Mark. I don't know if you have a question about that before I get into a couple of those.
No, jump right into it. Let's go.
Okay, very good. So, a lot of you that are watching this are probably missing out on some of the uh, lower hanging fruit tax items that I like to call them. And for those of you who have kids, even grandkids, believe it or not, there's different ways that you can pay them through your entity and not exceed that 15,750, which was allocated this year. And it's something that I've been doing for many years, where paying my children. So I'm capturing that write-off, and it's through my business. That is something that maybe you can't take advantage of the full amount, but before you pay anything to the state or to the IRS, are you in a position where you can pay them? And some people say, well, I'm a truck driver, or I'm in an industry, I can't hire my kids. Have that conversation, because believe it or not, it's something that is not heavily scrutinized by the IRS. Knock on wood, I've never had a client audited in my 20 years and 13 years of owning corporate capital, because it's something that they know a lot of business owners and entrepreneurs are going to take advantage of. Another one, Mark, is, and anyone can research this, the Augusta Rule. That is something where, again, I've been doing for 7, 8 years now, 14 times. And this happened and started in Augusta, Georgia, where the Masters is. And what happened was they were going to these extravagant vacations and these events, and they were writing everything off. So the IRS said, okay, we will allow you to write off for these meetings, right? Quote unquote meetings. However, there has to be a cap. So the cap was 14 times a year. So what I do is 14 times a year, I have a meeting at my home, and then I compensate myself $2,000 for that meeting. So that is $28,000 right there of money that I can get from my company legally, pay myself. And of course, I don't have to, my mortgage or whatever I have for my monthly expenses, but instead of me going to the Wynn or the Bellagio or Del Frisco Steakhouse, the IRS allows you to do that. So that's something that you guys can still implement this year. So if you are worried about your tax bill, have that conversation with your CPA. If you don't have a CPA, the number that I have set up directly for Mark is 855-767-1977. I'll repeat that one more time. It's 855-767-1977. And we are more than happy, Mark, I don't know if I mentioned this prior, to just do a consultation, review last year's tax return, just have that conversation with them to see where they're going to be at before the end of the year, because we still have time to implement some of those strategies. Now, and then any questions you have, sir, but on top of that, what we do here is we work with different family offices. So we have clients. The last couple examples, C. Martin, I'll use the initials, we were able to save $2 million in taxes. So we had to write a check for $900,000, but he was able to save $2 million. So you better believe he wanted to write that check for 900 instead of the check for 2.9. So for those of you who really exceed that and you're paying 300,000-400,000 or more in taxes, then that's when we can start looking at some of the additional tax credits and advanced tax planning strategies. And those are also very important to do before the end of the year.
Yeah, that's huge stuff. So let's what else besides that? Like, what is one of the big things like a lot of investors or real estate investors miss, or their CPA? Like, quite frankly, that's why I kind of went to you guys, because my other CPA was missing some stuff. And I've been working with you guys for quite some time, and you guys saved me quite a big difference compared to my other CPA, just because he missed a lot of items.
Yeah, and one thing that we do with our clients, Mark, is when they first enroll, and we don't like to charge by the hour, because we want clients to feel comfortable. We want them to be able to call, send emails. That's kind of the worst relationship, when you feel like you need to be rushed like that. So for years and years, as you know, we just, we have a flat rate we give our clients. And with that, we want them to ask the questions. We want to have that relationship, but we get them a tax planner. And believe it or not, this tax planner basically has everything that they should be writing off in their business. And that right there is the first indication, because a lot of people weren't aware of some of the expenses. They were not aware of these tax planning strategies. So the first step that we take after enrolling them is looking at last year's return, looking at where they're at this year, getting them that tax planner so they don't overlook any of those deductions before the end of the year. And then maybe some of those deductions that they didn't know about make sense for the growth of their business, which we would want them to take advantage of before the end of the year as well.
It's funny that you said that you guys don't charge. So like my old CPA years ago that I was using, he would charge to $150 an hour just to have a consult. So I remember I just had a quick question, and what would happen is you would end up booking a call, and the conversation really is only 10 minutes long, but you feel like I got to sit here and waste my extra 45 minutes because I need the $150 where I could have just gone off and gone and made my money. And it's kind of glad that you do that, because a lot of times you can just have a quick, I think we had a quick phone call a few weeks back, and it
Yeah.
was like literally like 4 minutes long instead of drawn out for a whole hour. You know what I mean?
Yeah. Yeah. And it's kind of the same thing with Josh, our head CPA here, who does my taxes. I know you work with him, and he's very, very good about that. And we believe in spending that time. And honestly, it comes back to you tenfold, Mark, as you know, with your following. You spend time with them. We have grown because of these types of relationships. We don't advertise. We have people like Dave Ramsey, who's got a great following, who comes to us and says, "Hey, can you work with all my clients in Southern Nevada, Las Vegas, Pahrump, Henderson?" And the reason we've gotten to that point is because you have to have that relationship. And I just encourage everyone, even if you can establish that relationship with your current CPA, because some people are very happy where they're at and they want to stay with them, which I understand and I support. But then I also ask them this question: well, if you've been paying this much in taxes, and then you go back and ask about these strategies, and they're like, "oh yeah, you qualify for them." My first question would be, well, why the hell haven't we been implementing them, to this point? And then I've also had people go to their CPA with some of these strategy meetings, and then they'll say, "you know what? This is good. I just researched it. You do qualify. We'll learn together." And again, to each their own. But the main thing is, and I love the country we are in. I don't mind paying taxes, but I know that I am going to pay the absolute least amount. And at my age, I am making an outstanding living. I own this beautiful building we're in. We're a multi-million-dollar corporation. I have a partner. I don't mind paying the taxes at the end of the year because I know that those strategies, my VFO, the virtual family office, the paying of the kids, the Augusta, I've done everything I can. So I will happily write the check, as opposed to some of you are very hesitant because you're wondering, did I miss something? And that's all that happens all the time. And the reason I want to point that out is a lot of account CPAs, they just want to kind of run you through the mill, like just kind of take your order, spit out a tax return, and then you're happy. That's just not the approach that we take. And I think you'll find, if you were to have that initial consultation, our approach is very unique, where we just want to understand what your goals are. Again, maybe your goals are to pay the least amount in taxes. That is everyone's goal. But then you have some people here in Vegas, especially Mark, that may bartend or dance, right? And now they want to claim they make 30 grand, but they want to buy a house that's worth 450. You can't have your cake and eat it too, right? So we like to look at our clients' goals for that year so we can make sure that they accomplish those, whether that's increase their portfolio and qualify for loans, or look as broke as possible to pay the least amount in taxes.
Nice. Now, what about like people like, say for example, if somebody's listening to this and they want to come over, can you go back? Can you go back like and modify or amend previous tax returns for certain things that would have been missed?
That's a great question. 3 years. Yes, sir. You can only go back 3 years. Now, the IRS can go back and audit us as long as they want, take our money, but they're only going to give us money back for 3 years. So if you feel like you've overpaid, or, some of the things, because even, for example, like a cost segregation, and Mark, you probably know this more than anyone that's listening. Well, I shouldn't say that. You got some intelligent people, but with the cost segregation, that's one of those strategies you can implement after the fact, but everything else that I've kind of talked about needs to be done beforehand. So maybe we look at that for 2024, and you possibly could have incorporated, something like that. Or if something was blatantly overlooked, then absolutely we can file an amendment, or you can file an amendment, I should say, and the IRS will allow you to go back 3 years. And this is what I tell people to that, Mark. If you overpaid in your taxes and it's black and white, let's go get it. Okay, let's go get your money. If it's a few $100s, let's not kick a sleeping dog. Okay, let's not go after them for 500-600 bucks, because the IRS loves taking our money. But when you give it back, or when they give it back, now all of a sudden that 5-letter word can happen, and no one wants that, right? Starts with an A. So I usually tell people, now again, I've never had a client audited in the existence of my business, and as long as I've been in this industry. So we will tell our clients, yes, you left money on the table. Here's why. Here's how much. Here's how much it would cost to amend. Do you really care? And if we're talking thousands of dollars, let's go after that sucker. But again, these are the types of conversations that we like to have prior to just filing a return or just moving on to the previous year. So I would love to look at their previous tax returns, and that would just be part of like that initial consultation, because we want to make sure we're the right fit for your group as well.
So before we get on to some other products that you guys specialize in,
Yeah.
what do you see coming up? Is there anything that people should be aware of that's coming up with this new, big beautiful bill that's helping business owners coming in? Now, what's that? That goes in effect January 1st, or is that retroactive? How's that looking?
The big beautiful bill. So the big beautiful bill, there are some advantages, especially for our bigger clients, like in the construction. And I'll be very candid when it comes to my relationship. So being one of the owners at Corporate Capital, I do a lot of the corporate structuring. I do a lot of the estate planning that we'll talk about. Obviously, I've been doing this for 20 years, so I know the taxes. I do the consultations with the clients, but my familiarity with the big beautiful bill, and it is not the same as my partners, like Josh and Nate. So as far as any specific questions for that, we'll do that one-on-one, because I don't know of any specifically for real estate investors off the top of my head. And again, I always like to be transparent with my
Sure.
information, but I do know that there are some really, again, depending on the size of your operation, our clients in Utah that have these multi-million-dollar like construction companies. If you are just not a real estate investor that's buying and flipping homes, if you have companies like that, then that bill definitely will pertain to you. I don't know how much it will pertain to you for just buying and flipping homes and advancing that portfolio that much. And then what was your
Nice.
second part of that, Mark?
No, I just in general, because I know that I think they're doing like bringing a lot of stuff back. I don't even know. It's just we'll see how it plays out. But yeah, Josh would be probably usually that should have been a Josh question. But yeah, let's get into estate planning. Let's talk a
Yeah,
little bit about that, what you guys do, and I know that's your specialty. So let's talk a little bit about that as real estate investors. What can you guys do? What do you recommend, and et cetera?
yeah. Well, there's a couple different trusts that we focus on for our clients. There's many different trusts that you can set up, from life insurance trusts. Um, but we focus on the revocable living trust is the very first one, Mark. And the reason being is the government, the states have told us, if you pass away, we'll make things easy on you. Make sure your businesses, make sure your bank accounts, make sure your resident, make sure anything that has Mark Monroe or Brent Carlson's name on it is inside of this trust. Because if you don't have that, then all of this time and all this money that you've created to build this portfolio is going to cost someone not only grief, but probably 50 to $100,000 of probate, depending on what your portfolio looks like. I mean, my cousin Mark had to pay $10,000 2 years ago when his parents died here in Nevada, and they only owned one home. They didn't have any businesses, they had no bank accounts, they had one house, and the cheapest retainer he could find was $10,000. So you can set up a trust for significantly less than that. And now you have your power of attorney. So you have someone that is able, usually the spouse for each other, and then the oldest child, or there's a line of executors and people that are going to be able to make your healthcare decisions. I lost my dad this summer at 69 years old, and it was out of the blue. But obviously, being in this industry, I made sure his trust was done. Inside of his trust, he put in there that he did not want to live like as a vegetable. So after he had his stroke, he lost his ability to speak, which was his greatest talent. At that point, mom knew that she had the authority to make the decision. He didn't. So we tried the surgery. We lost him. But inside that document, it stated what his wishes were, as opposed to the hospital wanting him to live with a tube in his mouth because that was guaranteed for him to live. But that's not the quality of life he wanted. So your trust has all of this powerful information as far as what do you want in the event that you're in a coma, who has the ability to sign on your behalf. And then the most important thing is the last will and testament. So that last will and testament, and many of you probably have a will, because a lot of attorneys will advertise, set up a will. And it really makes me cringe, because I've never offered just a will, because a will go through probate. So attorney will advertise a will, and then when the family member passes away, guess who they call? They call that attorney, and then that's when they get their $15,000, $30,000 retainer, because the will must go through probate, and they're familiar with that group. If you have a living trust, your will is part of that, Mark, and that will have all your beneficiaries listed. So now all of your clients, all your followers, all of our assets are going to go to our spouse, and they're going to go to our children, and there's not going to be a probate process. But if you pass away and have any of those things in your name, then they will go through probate. Now, I'm big on stories. I have two widows that are waiting on $98,000 from Wells Fargo and $440,000 from US Bank. This is over a year. I might even talked about it on our last interview, because that's how long they've waited. But the husbands were the only ones on the bank account, and unfortunately, they must go through probate. So it's really black and white. Unless you want everything that you're currently sitting on that is in your name. Now, our jewelry, our necklaces, obviously that's not going to go through probate, but inside your trust, you're still going to list all of those items. And like my Corvette's going to go to my son Giovanni. The necklace is going to go to Cole. I have another necklace for my son Jordan. So I put all of that inside of my trust, so there's no infighting. The last thing you want to have happen is the grief, the probate, and now the infighting. Mark, I know you've seen it. I've seen it for 20 years. And I love it when there is none, because you can't challenge a trust once it's done. They have to follow the letters of the law. But without one, it's the wild, wild west. So the revocable living trust is just good to make sure that your loved ones, your spouse, are taken care of. The challenge with that, though, is there's no protection inside of a revocable living trust. So
Okay.
yeah, so what we do for that, to cover that, is in Nevada, and I really encourage everyone to write this down. It's called the Nevada Asset Protection Trust. It is an irrevocable trust that I have set up. Again, I'm big on examples, and if I'm going to do these types of interviews, and then I want to make sure that I use my real life scenario. So I own the building that we're in, Corporate Capital 7848 West Sahara. That's in an LLC called Mac Holdings LLC. Corporate Capital, we're a multi-million-dollar company that does LLCs. We help do accounting, bookkeeping, and the estate planning. I have another entity that does my audits and reviews, because there's a little bit more liability in that. So I made sure to separate my liability. Now, the ownership of those companies is the MJ23, my Asset Protection Trust. So now my Asset Protection Trust, which has been around for about 5 years now for this specific structure, after 2 years, anything that is inside of this trust is protected, Mark, from any type of creditor, any type of litigation, even bankruptcy. So you could put land, I have cash in there, you can put guns, you can put your business interests. So what does that mean? Now, if Mark Monroe gets sued personally, or Brent Carlson gets sued personally, I don't own the shares of a multi-million-dollar building or a business or this audit and review company. So it's own nothing, control everything. That's truly how I'm set up. So all of my business assets and all the stuff that I really want to protect from the outside world, and I call it the two L's. I really feel the fastest way people want to get rich is lawsuits or lottery. So to avoid that, by incorporating this Nevada Asset Protection Trust, it gives you the protection to protect everything you have. Now, the best part about it is you are able to transfer assets in and out, which I have personally done. So you can transfer assets out. The kicker is if you transfer an asset out and put it back in, then the 2 year starts over. That's the only downside. But people ask me all the time, well, isn't an irrevocable trust like a black hole? Most states they are. Most states, when like my client in Colorado that has a $450,000 condo, she tried to get a line of credit. She couldn't because it was in a Colorado irrevocable trust. So until her daughter turned 25 is when the trust expired. This trust, you can transfer the assets in and out. So if you have these businesses, if you have some of those assets I mentioned, if you have whole life policies and you're doing the infinite banking, these trusts can own all of these types of things, Mark. Land trusts
Nice.
that people have set up for their LLCs. I know you're a big land trust guy, so am I. So your land trust, if it's beneficial owned by the LLC, then the LLC we would have assigned to one of these trusts. But the last thing we want to have is the final ending point being Mark Monroe or Brent Carlson, because now all of our stuff is going through probate. So we have a way of avoiding probate, and then we have a way of protecting it as well.
Nice. No, that's good stuff. And
Yeah.
it's really critical, especially, I've heard stories of nightmare stories, somebody backing up and accidentally run over a child. It's just an accident and they lost everything. So you want to be careful of because they can certain this is depending on also LLC structures. And let's talk a little bit about that. We talked
Yeah.
about the trust, and
Yeah.
now let's talk a little bit about LLC structures because I know you guys specialize. You do a lot of that because that also plays a big factor in how to structure these. Unless there's something else in the trust that I did not ask.
No, no, I honestly I think we covered enough to where
Okay.
people are going to realize like, well, first off, if you're married, if you have kids, oh, this is another thing I didn't mention. I'm glad you asked that. Inside of my trust, I have a 21, 18, 13, and 10-year-old. So, but it was my mom and dad are the legal guardian, now just mom. But mom is the legal guardian of my 13 and 10-year-old now because my son just turned 18. And then my brother-in-law is the backup. So for those of you who have young children, sometimes people think, well, I'm too young. I don't need a trust. Bull crap. I think that you need one for any of the reasons I mentioned, and especially if you have children, because now you get to control who the legal guardian is as opposed to the courts deciding that. I had a client, Corinthian. He passed away in a motorcycle accident when he was 29 a few years ago. He didn't have a trust. He had a very strange relationship with his dad, like fist fights, Mark. It was very bad. He talked to me about it all the time. Well, at 29 years old, who thinks to have a trust? I push the heck out of it. I don't care how old you guys are. I think you should have one. He passes away. His dad is retired. He's the only one in town, basically the only next of kin. So what did the judge do? He gave this daughter to grandpa who's retired that can take care of her. Corinthian would be rolling over. I swear. He would be so upset. But unfortunately, he didn't take the time to do these things that are told to us at a very young age, that are in front of us all over. If you have social media, everyone talks about LLCs, trusts, the things that we're doing. And you have to ask yourself, why don't I have at least a revocable living trust? That's the question. So I appreciate you asking that. There was another example about probate that I was going to give, and if it comes back to me, I'll revisit that. But let's do talk about LLCs and corporations. So for the most part, Mark, we are setting up more LLCs than corporations. I'd say it's probably 99 to 1. So out of every 100 entities, we're forming LLCs. Now we are doing most of those in the state of Wyoming. Even though I'm here in Nevada, my business is headquartered here in Nevada. Unless my clients physically live in Nevada, I am setting them up with a Wyoming LLC. And here's why. Wyoming is one of the cheaper states to set up the entity, but that's not even, who cares about that? The reason we incorporate our clients there is number one, there's no state or corporate tax. So you are not putting yourself in jeopardy of paying a double taxation or taxes in Virginia or New York and Wyoming because Wyoming doesn't have tax. Why do we headquarter our clients there? Wyoming law, and this is all over the internet, TikTok, whatever you're into, Wyoming law is very black and white, where if the business gets sued, you cannot sue the business owner personally. So you can go after the property, you can go after corporate capital, but you can't go after Brent Carlson because Nevada, Wyoming, Delaware, they do not allow the corporate veil to be pierced and hold us responsible. So a lot of clients that have already structured their companies outside of those states, we'll have a conversation with them about possibly having a holding company that now owns the interests of these other operating entities. So the event that they ever get sued, they know personally they are never in jeopardy. And then there's other times sometimes that we'll look to convert them just from where the state they're at into Wyoming if they're looking for that protection. But the main thing is by having that LLC at the end of your name, you are separating your liability. And even if you set it up in your home state, you are still doing yourself a huge service because you have separated your liability and that LLC should do its job. However, to just have the complete peace of mind, we incorporate and headquartered in Wyoming because Wyoming statutes say unless you commit fraud, you cannot go after the LLC and the business owner. And unfortunately, the other 45, 46 states in the union allow you to go after the LLC and the business owner, and Wyoming doesn't allow that. Now, why we're doing so many LLCs? LLCs can be taxed however you want, Mark. So they can be taxed as a single member LLC. If someone's intention is to have a corporation, their LLC can actually be taxed as a C corporation. I have one that's on a fiscal year tax as a C corp. Your LLC could be a partnership if there's a true partnership. And then what most people do that make good money through their business will elect to have the S election. So your LLC could literally be taxed any way it can, the same way as an Inc. But a corporation is more difficult to maintain. You have to do your minutes and shareholder agreements. You don't have to do that with an LLC. It's a limited liability company. So it's very simplistic, but it's so powerful when it comes to protecting. So for those of you that are watching, probably have many pieces of real estate. If those are in your personal name and something happens on any of them, they can go after the entire portfolio. However, if you have those in separate LLCs, or in some states, they'll recognize what's called a series LLC, where you can set up one LLC and literally put 20 properties within one LLC. So what does that do? Instead of them keeping them in your name where they're all at risk, you've literally separated the liability of each individual asset. So if something ever happens, the insurance does its job. They can go after that property that's down the street, but they cannot go after the rest of those. In Virginia, I think that's where you're at, Mark, right? Virginia?
I'm in Florida.
Oh, Florida. Okay.
That's all good.
Virginia is one of the states. I've gotten a lot of clients from your following out of Virginia. That's probably why. Virginia is one of those states. Wyoming, Nevada, Illinois, Indiana. So if you just Google states that recognize series LLCs, you can set up a Wyoming series LLC, register it to do business in one of those states, and now have one LLC that literally, like D and L Smith in Tennessee, they have 32 properties under one LLC. So that means they only had to set up one LLC and they have one renewal each year instead of having like some states where you have to have 30 separate LLCs to legitimately separate the properties. But then that's why a lot of people will lose land trusts as well too, sir. So
Right. Yeah,
yeah.
because of that. Yeah, I like that. So is that new, the series LLC for Wyoming? Is that somewhat new?
So the Series LLC has been around for a little while. The states are
For
starting
Wyoming,
to
no. Is that
uh,
new for Wyoming?
What it's newer. They've had it around
Yeah.
for a while, and it's
Okay.
something. Yeah. So, but Wyoming, their statutes have been. So we started back. Wyoming's 2008, 2009 started adopting similar statutes to Nevada. So we kind of wanted to see how it played out. And now, me personally, any new company I do for any investment outside of Nevada is all Wyoming. And yes, if clients live in a state that will recognize the Series LLC, then we'll go over that with them to say, hey, you might be able to avoid setting up 10 LLCs, accomplish the same goal, have one LLC, and then what happens now is you have a master series here. And now you have just your little spider webs coming off of it. So Series A would have a property in Indiana. Series B would have a property in Nevada. Series C would have a property in Virginia. So now that one LLC is legally separating those assets. Now, can I use that for multiple businesses? No. The only time you can use a series LLC, Mark, is for real estate purposes. If you guys are running multiple different types of businesses, then you would need to have separate LLCs, again, depending on the nature of the business.
Okay. It's good.
Yeah.
So we're coming to the this is great stuff. We're coming to the end. We talked about taxes, we talked about, estate planning and asset protection, and then we talked about the LLC structures. Is there anything else that you want to touch base on before we is there a question again I didn't ask that I should have?
No, honestly, the relationship that you and I have and the times that you speak from the stage and the callers, they're very savvy, Mark. I think for the most part, going over the information we did as far as are you in a position where you need some end of the year tax planning? Are you getting older? One thing would like to add when it comes to the trust, just get it done. I would love for it to be corporate capital, but go down the road, get it done from anyone. Because the last thing I want people doing is having what happened to my dad or having what happened to many families out there. And now all of a sudden you find out that you're very sick. Some people get through it and battle through. Some people don't. The last thing I want you worrying about is going into the bank and contacting the insurance company or all the steps that, because it's not like you can just set up a trust and go like this and poof, everything's in there. You got to quick claim it. We got to get the property transferred in. We got to sign the company interest. You have to go to the bank and show them a copy of the trust so you can, at time of death or transfer of death, it does its job and goes into the trust. So I there's urgency with taxes. There's urgency with the estate planning. So again, your audience, if any of those are a deed right now, then call that 855-767-1977. And you'll either speak with Flo, who's one of our original founders, Dirk, who's my VP of Business Development that runs my Utah division, or myself. And a lot of times you'll see that I will take the call. So that number will ring to the five people. I have two assistants, office manager and a personal assistant, Jocelyn and Taylor. If you would like to speak with me direct, then just let them know, and then they will offer some times. And we usually offer between 30 to 45-minute consultation for Mark's group. And again, we do not charge for that. So if you just have questions, you want to go over some of the things that we discussed, you'll see there's no strings attached. And as the owner and CEO, I'll be very candid. I don't have a lot of time to chase people down and such. So I like to have those conversations, see what they need, and then I put the ball in their court. And then, it's either a good fit or not. But for the most part, we're just here to answer the questions, make sure you guys feel comfortable going into 2026 and that you've done everything you can for 2025. That was the main purpose of what Mark and I wanted to accomplish today. So thank you for that
Right.
opportunity, Mark.
I absolutely. I always appreciate. You always give so much value, and you always helping so many people, listeners in the community that we work with. That's all about is helping and giving value to everybody. So, what
Thank
we'll
you.
do is we'll go ahead and post a phone number below
Yeah.
wherever you're listening or watching this podcast or video from. Again, it's that time of year. You want to try to get on the phones and make sure you have. If you have any questions, you're not sure and you're worried about getting hit with the taxes. Right now is the time to do it. And Brett. Thank you, Brent. Thank you so much for coming on, and I appreciate it. All
Of
right.
course. Of course. I really appreciate you having me, Mark. And next time, the next one we do, maybe we'll have Josh or Lenny or someone else come on to go over some of those specifics for the big beautiful bill. Maybe we could try to do something early next year and have Josh talk specifically so we can get those questions answered for your general audience. Okay.
All right. I appreciate it. Thank you
Uh,
guys for listening to another episode of Real Estate Power Play. We will see you next time. Peace out.